There is a number that almost nobody is talking about, not the S&P 500, not the unemployment rate, not inflation, not even Berkshire Hathaway stock price. The number is $775 trillion. That is the total assets sitting in money market funds across the United States as of the week ending May 13th, 2026, confirmed this week by the Investment Company Institute. Not 2 trillion, not 4 trillion, $7.75 trillion. To put that in context, it is more than the entire GDP of Japan, the world's third largest economy. It is more than the combined GDP of Germany and France. It is nearly 1/3 of the entire US economy, sitting in instruments designed to do one thing above all others: not generate returns, not compound, not grow, be ready to move. That is what this money is doing, waiting. And the people who control it are not waiting because they are unsure what to buy. They are waiting because they have decided that the cost of being wrong in this environment is higher than the cost of missing a rally. That is the trade that $7.75 trillion is making. And when that much capital makes that trade simultaneously, it is not random. It is a signal. This is Capital Briefing. If you are here for the first time, subscribe now before we go further. Turn on notifications. What we build on this channel is the translation of what institutional capital is doing before the public narrative catches up. The gap between when structural shifts begin and when they become headlines is exactly where the most consequential positioning decisions get made. Subscribe now. Then let me show you exactly what this signal means. Let me start with Berkshire Hathaway, because it is the most visible and most documented example of what I am about to describe, and because the scale of it has not been fully absorbed by most observers. At the end of the first quarter of 2026, Berkshire Hathaway reported $397.4 billion in cash equivalents, and short-term U.S. Treasury bills on a consolidated basis. That is the highest figure in the company's history, not just the highest in recent years, the highest ever. Of that $397.4 billion, approximately $339.3 billion is in short-term U.S. Treasury bills, instruments that mature in less than 1 year, that pay yields in the range of 3 to 4%, and that can be converted to cash within a single business day. Berkshire chose this, not because equity markets were closed to them, not because there were no businesses to acquire. The S&P 500 has been near record highs. AI companies are trading at multiples that would have been unthinkable a decade ago. The equity market is not short of assets to buy. Berkshire looked at all of that and chose T-bills. At the most recent annual meeting, Greg Abel, who has taken day-to-day operational leadership from Warren Buffett, confirmed this posture directly. Berkshire will not force capital into overvalued assets simply because the money is available. That last sentence is worth sitting with. They have nearly $400 billion. They could deploy it tomorrow. They choose not to. The decision to hold $339 billion in short-term treasuries, earning roughly 3.5% when equities are near all-time highs and AI is generating headlines. That is not a passive decision. That is an active, deliberate choice to prioritize the ability to act over the return from acting now. And Berkshire has been making this choice consistently. They have sold stock for 14 consecutive quarters, not bought, sold. While the market was rising. Subscribe to Capital Briefing if this framing is delivering the structural context you have been looking for. Turn on notifications. The next video on this channel examines exactly what Berkshire's historical cash accumulation pattern has preceded, and what the data from the last 5 episodes of major cash buildup tells us about what typically follows. Subscribe now. Then let me take you inside the mechanics of why $775 trillion in money market funds matters in a way that most commentary misses. There is a distinction that almost no mainstream financial reporting makes, and it is the distinction that makes the $7.75 trillion figure so important. Most reporting treats money market fund growth as a consequence of high interest rates. The logic goes, yields are attractive, so money has moved there. When the Fed cuts rates, the money will flow back into equities. Nothing to see here. That analysis is incomplete. It misses what is actually happening at the institutional level. Look at the composition of where the money is going within money market funds. As of the week ending April 8th, when the total reached its peak of $7.82 trillion, government money market funds absorbed $9.68 billion in net inflows in a single week. Government money market funds are the category backed specifically by U.S. Treasury securities and Treasury-backed repurchase agreements. These are not investors chasing yield. If yield were the primary motivation, they would be moving into prime money market funds, which hold commercial paper and corporate instruments and historically pay higher yields than government funds. They are moving into government funds, Treasury-backed, maximum liquidity, minimum credit risk. The week of April 8th generated $13.25 billion in institutional inflows alone, not retail institutional, into money market funds, while the S&P 500 was near its recent highs. This is the institutional signal that matters. Professional money managers, the people running pension funds, endowments, corporate treasury operations, family offices, are increasing their treasury exposure. At the same time, equity valuations are elevated. That combination, high equity valuations plus institutional flight to short-duration treasuries, has a historical pattern. It does not repeat perfectly, but it repeats. Let me take you through the historical episodes, because they are instructive not as predictions, but as structural parallels. The first episode is 1999 to 2000. In the 18 months before the dot-com crash, institutional investors began extending their treasury bill exposure while continuing to make public statements about the productivity revolution and the new economy. The S&P 500 reached its peak in March 2000. Money market fund assets had been growing steadily for 2 years before that. The public saw the headline numbers, the equity highs, the IPO mania, the Nasdaq at $5,000. And interpreted them as signals of permanent prosperity. The institutional flow data, which fewer people watched, was showing something different. The people closest to risk were quietly repositioning. The second episode is 2007 to 2008. Lehman Brothers filed for bankruptcy in September 2008, but the institutional repositioning that preceded it was visible in Treasury demand data months before the collapse. In the 12 months before the peak of the financial crisis, short-term Treasury yields compressed dramatically, not because the Fed was cutting, but because demand from institutional buyers seeking safety was driving prices up and yields down. The SVB collapse in March 2023 is the most recent and most compressed version of this pattern. In the 72 hours following Silicon Valley Bank's announcement of its securities losses, depositors withdrew $42 billion in a single day, the fastest bank run in history. The mechanism was identical: perception of liquidity risk triggering immediate flight to Treasury-backed instruments. Money market fund assets grew by $286 billion in the 2 weeks following SVB's failure. These are not isolated events. They are expressions of a recurring mechanism. When institutional money perceives systemic risk, whether in specific institutions, in equity valuations, in the sustainability of fiscal trajectories, it moves toward the shortest duration, most liquid, most sovereign-backed instrument available. U.S. Treasury bills are that instrument, and they are receiving $7.75 trillion of that allocation right now. Now let me explain the mechanism that connects the fiscal backdrop I have described in previous videos to the current flow into short-term treasuries, because this is where the structural analysis becomes most important. There is a reason that institutional capital is specifically choosing short-duration instruments: 4-week bills, 13-week bills, 6-month bills, rather than longer-duration treasuries. The reason is duration risk. When interest rates are uncertain, when the trajectory of central bank policy is not clear, when fiscal pressures create ambiguity about whether central banks will be able to raise rates if inflation returns, long-duration bonds carry significant price risk. A 10-year treasury that yields 4% loses approximately 8% of its market value for every 1 percentage point rise in interest rates. Short-term T-bills mature quickly. They reprice at each rollover. If rates rise, the new bill captures the higher yield. If rates fall, the investor simply rolls into the new instrument at the lower rate. The duration risk is minimal. Smart money is not just choosing safety. It is choosing safety with maximum optionality and minimum duration risk. The specific preference for short duration instruments in the current environment is a direct expression of one underlying conviction: that the range of possible outcomes for interest rates and inflation is unusually wide. When the range of outcomes is wide, you want to be in the instrument that allows you to adapt regardless of which outcome materializes. Short-term treasuries are that instrument. That is the architecture of the positioning that 7.75 trillion represents. Now let me address the counter-argument directly, because it is real, and it is the one most commonly deployed by financial commentators who dismiss the significance of these flows. The argument goes, this money was always going to be in money market funds because rates are attractive. When the Fed cuts to 2%, it will flow back into equities. There is no systemic implication. This argument fails on the data for three reasons. First, institutional inflows into government money market funds have continued even as equity markets have been near all-time highs. If this were purely a yield-seeking behavior, the comparison would be between money market yields and equity expected returns. At current equity valuations, S&P 500 PE above 27, the Buffett indicator at 227%, institutional investors are making an explicit judgment that the equity risk premium does not compensate for the downside risk. They are not moving to T-bills because rates are high. They are moving because they believe equity risk is currently mispriced. Second, Berkshire's T-bill position specifically tells a different story than yield chasing. Berkshire earns approximately $10 to $12 billion annually on its T-bill position, a return they could mechanically improve by moving into investment-grade corporate bonds at slightly higher yields. They do not. They choose the liquidity premium of T-bills over the yield premium of corporate credit. That is a conscious choice to maintain maximum deployment optionality. Third, the 14 consecutive quarters of stock sales, combined with the T-bill accumulation, form a pattern that is directionally inconsistent with passive yield chasing. Passive yield chasers do not also reduce equity exposure for 3.5 years. That combination represents an active judgment about the relative attractiveness of holding dry powder versus deploying it. Let me now explain what the data suggests smart money is actually waiting for, because this is the part that has the most practical relevance. The opportunity that institutional capital is positioning for is not a specific event. It is a structural condition. In every historical episode of large-scale flight to liquidity that was followed by major capital deployment, 2008 to 2009, 2002 to 2003, 2020, the deployment happened when three conditions were simultaneously met. First, equity valuations compressed from elevated to fair or below fair. Second, a specific catalytic stress event created urgency among sellers. And third, capital with immediate deployment capacity could dictate the terms of its engagement. The Goldman Sachs deal in 2008, $5 billion at 10% with warrants, was only possible because the counterparty had no other access to liquidity. Berkshire had the liquidity. Berkshire set the terms. The same pattern occurred in every major distressed deployment in modern financial history. The party with liquidity during a liquidity crisis dictates terms that would be unthinkable in a liquid market. $7.75 trillion in money market funds is not passively waiting. It is actively positioning for the moment when the liquidity premium flips, when being the buyer matters more than being the seller. That is the structural logic behind the positioning. The question that most retail investors never ask is, what will I have when that moment arrives? If the answer is fully deployed in equities at 27 times earnings, in long-duration bonds with 8 years of price sensitivity, in real estate with 30-year financing obligations, the answer is that you will be among the sellers when the institutional capital that has been accumulating in T-bills becomes the buyer. If the answer is a meaningful allocation to short-duration, liquid, treasury-backed instruments, the answer is that you have the optionality to participate in the terms that the next dislocation makes available. That is not pessimism. It is the architecture of capital positioning by the most sophisticated market participants operating today. And it is visible, documented, and publicly reported in data that anyone with the right framing can see. The public is not seeing it. Not because the data is hidden, because the framing is not available in mainstream financial media, which is structurally incentivized to focus on equity performance and discourage cash positioning. What the data shows, and what this video has laid out, is a structural divergence between what institutional capital is doing and what retail narrative is saying. Institutional capital is moving to maximum liquidity at minimum duration risk. Retail narrative is focused on all-time equity highs and AI productivity gains. Both can be technically accurate simultaneously, and that is precisely the condition that has historically preceded the most significant wealth transfer events in modern financial history. Smart money sacrifices upside for optionality. When wealthy families prefer liquidity over return, something usually changes beneath the surface. Cash is no longer trash. Subscribe to Capital Briefing now if this video changed how you read the signal that $7.75 trillion in money market funds is sending. Turn on notifications. Leave one comment. One word if you prefer. When you look at your current portfolio, how much of it is positioned for the moment when the institutional capital that has accumulated in T-bills finally deploys? Because when that deployment happens, it will not announce itself in advance. It never does.